Hi everyone, welcome to chapter 20. In this chapter, we will be studying the accounting for leasing, both from a lessee and a lessor perspective. Chapter 20 is a very large chapter. We have 13 learning objectives, which I believe is the most learning objectives we've had from any chapter to date. So please invest adequate time in these concepts to make sure you're comfortable with both the lecture content and especially the tutorial content. Let's get started. Our first learning objective is to understand the importance of leases from a business perspective. Leasing is popular because it's a cost-effective way of financing property and equipment. It's especially true for items that become obsolete quickly because the risk of obsolescence is transferred from the lessee to the lessor. From an accounting standpoint, leases have been controversial because many have historically been reported as off-balance sheet. And there has been a new accounting standard under IFRS that has made some dramatic changes to the accounting for leasing and has eliminated this off-balance sheet possibility. Lease transactions under old accounting were treated as rent expense, so there was no separate recording of the related asset and liability, and some of that's still popular under the ASPE standards today, which we'll talk about as we progress. Standard setters have been concerned about this lack of transparency, and as a result, effective January 1st, 2019, a new IFRS standard was issued to address the issues of transparency, comparability, and disclosure. Learning objective number 2, explain the conceptual nature, economic substance, and advantages of lease transactions. A lease is a contractual agreement between a lessor and a lessee. This agreement gives the lessee the right to use specific property that's owned by the lessor. And this is provided in return for lease payments, and it's a specified period of time. An essential element of a lease is that the lessor transfers less than the total interest in the property. The obligations for taxes, insurance, and maintenance, which are executory costs, may be assumed by the lessor or the lessee, and it could also be paid by a dividend. And that's all going to be stipulated in the lease contract itself. Now, because a lease is a contract, the provisions that the lessor and lessee agree to can widely vary from lease to lease. The lease's duration, the lease term, it could be anything from a short period of time to the entire economic life of the asset. The lease payments may be the same each month, or they may increase or decrease, or they could be predetermined, or they could be paid in relation to sales or some sort of consumer price index or other factor. Typically, rent is set at an amount that enables the lessor to recover the asset's value plus a fair return over the lease. And when the lease ends, several alternatives are available to the lessee. They may range from simple termination of the lease to the right to renew or to the right to buy the asset at a nominal price. So leases can also be cancelable, or they could give the right for early termination. This is all specified again in the lease contract. And we've already talked about the rights at the end of the lease. So advantages of leasing. So there are some disadvantages to leasing, such as the fact that the lessee doesn't own the asset and they're not able to pledge it as collateral. However, the significant growth in leasing does show that there are some genuine advantages over buying an asset. So some of these advantages include 100% financing at fixed rates with no money down and fixed payments. The lessee has protection against obsolescence, so they pass the risk of obsolescence through to the lessor, although that may be complicated depending on what the lessee has to agree to in terms of the residual value of the equipment. They may be required to transfer a payment at the end. Flexibility, it has less restrictive provisions than other debt agreements often. It's less costly financing for the lessee, and there's tax incentives for the lessor. And in ASPE specifically, so not in IFRS, but in ASPE, there is the potential that it could be off balance sheet, meaning that you'd only see the P&L impact and there's nothing sitting on the balance sheet to impact any of the ratios. The conceptual nature of a lease. So let's talk about an example before we get into these different ways of thinking about lease accounting. So if an airline borrows $180 million on a 10-year loan from the bank to purchase a Boeing 787, it's clear that an asset and a liability should be reported on the balance sheet of the airliner. If the airliner purchased the same aircraft for an installment loan, it would also be clear that there should be an asset and a liability on the balance sheet. But where it gets complicated is, what if the same aircraft was being used, but to pay for it, there was a non-cancelable lease transaction with payments in the exact same amount that would have been calculated under the installment loan. But because it was a lease, there's different opinions about how that transaction should be reported in the financial statements. And that will bring us well into these different alternatives here. So this is about substance versus form. So the legal title in that example where the 787 was being leased didn't pass, but the benefits from the use of the property are transferred. And so there's three different perspectives on how we should account for that. So the first is to say that it's an executory contract. And so because it requires continuing performance by both parties, we should not capitalize that transaction. And the argument is that we don't capitalize other executory contracts that require continuing performance, such as contracts with employees or purchase commitments. The next way of thinking about this is to use the classification approach, which is where it says that classification should be capitalized according to their economic substance. So installment purchases are capitalized, so leases with similar characteristics should also be capitalized, but also that if there's a transaction isn't an in-substance asset acquisition, then it would not be capitalized and it would be treated as an operating lease. So really trying to figure out like what's really going on in the contract and aligning it with either a capital lease or an operating lease. The third approach is the contract-based approach. So the contract-based approach says the leased asset acquired is not the physical property of the lessee, but the right to use that property is the right of the lessee, and the liability to make the lease payments is also the lessee's responsibility. So this is also called the right of use approach, and it justifies capitalizing the fair value of the rights and obligations in a much broader context. So what do the current standards require? So the standards followed by most lessees prior to 2018 or in 2018, prior to the issuance of IFRS 16 on January 1st, 2019, were really under the classification approach. And so this was looking at the substance of the lease and figuring out if it was similar to a purchase or similar to just an operating lease. And operating leases are considered off balance sheet because there's no asset or liability that sits on the balance sheet. You just have operating expense or rent expense going through your income statement. After January 1st, 2019, when IFRS 16 was applicable, IFRS 16 requires a contract-based approach. So the goal under IFRS 16 is to capitalize almost all leases. There are exceptions provided only for short-term or low-value leases, where it might not be worth to do all the calculations to capitalize the lease in the way that IFRS 16 requires. But other than that, there's no exceptions. Everything is capitalized because there's always a right to use the asset. And this creates right of use assets on the balance sheet, along with a liability for the lease payments. Now, ASPE still does permit the classification approach, so there could still be capital versus operating leases under ASPE, and we'll definitely talk a lot more about that. ASPE also does permit, of course, the application of the contract-based approach. As usual, you can elect into the IFRS type standards under ASPE. So IFRS 16 requires contract-based approach. ASPE, you can elect to have a contract-based approach, but ASPE also does permit the classification approach. Okay, so the current standards require the capitalization or the present value of the future rent payments. So this is specific to the contract-based approach. So we're going to calculate the present value of future rental payments. Actually, you would need to calculate the present value of rental payments under both ASPE and IFRS. So the first thing you're going to do is calculate the present value of the future rent payments, which are generally representative of the asset's fair value. The lessee records an asset and a liability and recognizes depreciation, assuming that we're talking about the contract-based approach or a capital lease. And the lessor and the lessee book rent as receipt or payment of interest and principal. And the lessor removes the assets from the books and replaces it with a receivable. And we'll talk more about lessor accounting in part 2 of the lecture. If benefits and risks are not transferred, the lease is classified as an operating lease under ASPE by the lessee, ASPE, and the lessor. Under an operating lease, the lessee simply records rent or lease expense, and the lessor records rental or lease income. Don't worry, we'll go through some more examples of that in the tutorials, and we're going to keep working through some more detail as to those slides that really just put some of those concepts out there. But I'm confident that after finishing the part 1 lecture and finishing the part 1 tutorial, you'll completely understand those concepts. Let's move on to learning objective number 3. Calculate the lease payment that is required for a lessor to earn a specific return. So the lessor determines the rental amount or the amount of each rent payment on the basis of the return that they need on the leased asset. So key variables in determining the rate of return are the lessee's credit standing, the length of the lease, the status of the residual value, if it's guaranteed or unguaranteed, and any income tax effects, which we're not really going to get into. Initial costs of negotiating and arranging the lease are added to the investment to be recovered, and deducted from the investment to be recovered are the present value at the end of the lease if there's a purchase option, and the present value of the residual value. Okay. So here's an example walking through the determination of rental payments. So a lessor expects to earn a 10% return on a $100,000 investment in an asset that is to be leased for 5 years. Annual rent is due in advance each year. So this is an annuity due basis, and I'll speak to that in a minute. There is no purchase option, bargain purchase option, or residual value. Determine the monthly lease payments due from the lessee to generate this rate of return. So what do we know here? We know that the lessor has invested $100,000, so the equipment cost $100,000 to purchase, and that they want to earn a 10% return, and that the lease will be for 5 years. The other thing that we're told is that the rent is due in advance, so it's annuity due basis. And what does that mean? Well, all throughout Chapter 20, almost all lease payments are due at the beginning of the term. If you think about a lease that you might have, or if at work you see the lease payment for your office building, the lease will always come out on, say, January 1st or February 1st. It doesn't come out at the end of the month. And so what that means is that when we're calculating these payments, regardless of how you're doing it, mostly we've been using a financial calculator, but whichever way you're doing it, you need to alter your calculations so that you're not expecting the payment to come out at the end of the period. It's coming out at the beginning. It makes a difference when we're calculating the present value or really anything from a financial perspective. Now, our previous chapter where we did a lot of calculations with financial calculators in particular were bonds. So chapter 14, and bonds, the payments are due at the interest payments are due at the end of the period. So we didn't have to make any adjustments for that. So it's really important to understand that with leases, the payments are due at the beginning of the period, which is called an annuity due, means that the payments due at the beginning of the period. And we'll have to make some adjustments to our financial calculators so that when we're putting in the inputs to calculate present value or other items, that the calculator knows that we're doing this on an annuity due basis. So let's look at how we would answer that question that we were just given. So step one is we want to determine the total investment by the lessor after considering any residual value or indirect costs. So in this case, we're just told it's 100,000. Step two is calculate the payment. So you can see I've written there, lease payments are due at the beginning of the period. So we have to set our financial calculators to BGN or begin mode, meaning that it's at the beginning of the period. I'm going to do a quick tutorial video just on how to do that, but it's pretty simple. So we'll walk through that in a minute. So then we know what our inputs are from the question. So we know that the lease was going to be for 5 years. We know that the lessor needs a 10% return. We know that the investment in the equipment was $100,000, and we're being asked to calculate the lease payments. So in order to get the right number there, let's switch our calculators over to an annuity due basis. So turn on your financial calculator. I've got this one here, if we can see it. Okay, so what I'm going to do is I'm going to clear out any work that I have in there, and I'm going to push second payment, second set. And you should see the beginning mode there. Second. Okay, if you want, you can pause this video here and just watch the quick tutorial video that's called setting our financial calculators to begin mode, because I'm not sure I gave the greatest overview there, but I'll do a better job in a video. Okay, so once we have that begin mode on, we simply put in N5 Is 10, the present value, which was the investment in the equipment of 100,000, and we calculate the payment. And so when you push calculate payment, you'll get $23,981. And so it's important to realize this is the annual lease payment. This isn't the per month lease payment. Remember, all the inputs that we put into our financial calculator are always annual. That's why we always need to make sure that the interest rate is annual. And that will give us the annual payment. So the lease payments over 5 years, what are the total lease payments? Well, we're going to take that annual payment and multiply it by 5 years. So the lessor will get a payment of $119,908. Okay. Let's move on to learning objective number 4. We're making some great progress here. Identify and apply the factors that are used to determine if a contract is or contains a lease under IFRS 16, and whether leases are capital or operating leases under the ASPE classification approach. So this is going to get into a little bit more meat here in this learning objective. So the lease criteria for lessees. And so this is for IFRS 16. Under IFRS 16, companies must first assess whether the contract is or contains a lease. A contract is or contains a lease if the contract conveys the right to control the use of an identified asset for a period of time in exchange for consideration. A lease can also be extent of use, for example, kilometers driven. A contract may include lease rights and service components. And service components are typically excluded from the lease. So if you have to service the equipment or do something like that, we don't consider that part of the lease itself. All leases under IFRS 16 are contract leases, except for short-term leases if it's less than 12 months term, or leases of low value. And again, that's really a materiality issue is IFRS 16 said, listen, if you have a really small lease that's not material, or if you have a really short-term lease, then you don't need to go through the calculations that are required under IFRS 16. You can just opt out and record it as an operating lease. If an IFRS exemption is applied, the lease is accounted for similar to an operating lease under ASPE. And again, it's really important to realize that those exceptions are few and far between, but it is important that we can identify them. Here's an example. A customer enters into a contract with an airport operator for the use of space for 3 years. The supplier has the right to change the location at any time. There are minimal costs to the customer who owns the kiosk used to sell the goods. There are many areas in the airport space that will fit the customer's needs. Does the contract contain a lease? No, it doesn't, because there's no identified asset, because the space can change at the discretion of the supplier. Let's take a look at low value leases. A lessor has the following leases: real estate office, manufacturing equipment, company cars, IT equipment, servers, and office equipment and furniture. So which leases would qualify as low value leases and therefore be exempt from IFRS 16? So it's a tricky one because they didn't give us the dollar value. So we're just being asked to say, what would probably be really low value or less than 1 year? All right. So the lessee determines that the following leases qualify as leases of low value assets on the basis that the underlying assets, when new, are individually of low value. So leases of IT equipment for individual employees, like laptops, are relatively small individual value. And the leases of office equipment and water dispensers are also considered to be individually of low value. So the guidance that we're given in IFRS 16 suggests low value assets would be anything with less than $5,000, and that the lessee can exclude those from the scope if the assets are individually less than $5,000. And it also specifies here that why the servers were not considered low value. And it's because although each individual module within the servers might be of low value, the lease of the modules within the servers do not qualify as leases of low value assets. And this is because each module is highly interrelated with the other parts of the servers. So you can't necessarily separate them out in the same way that you would separate laptops. And so the lessee would not lease the modules without also leasing the servers. So definitely a little bit complicated. I do find that the actual questions in the textbook will give you enough information where you can assess whether it's a low value lease. I do think that we were given a little bit definitely on the skinny side of the information here, but hopefully you get the idea around what we can exclude from IFRS 16, and that would be it. That's as far as it gets. It has to be low value or less than a 1-year lease. Excluded from IFRS 16, everything else is in scope and has to have an asset and a liability on our statement of financial position. Now let's talk about ASPE. So we just talked about IFRS 16 a little bit. Now let's talk about ASPE. So the good thing about IFRS 16 is that even though pretty much everything is in scope for being on our statement of financial position, at least we kind of know where we stand. There's very few exceptions, and most of the time you're going to have that asset and liability on the statement of financial position, and then of course an expense going through the income statement. Whereas with ASPE, because we're under the classification approach, meaning that we're looking at the economic substance, and we could be within the scope of a capital lease or also an operating lease, it is more criteria that we need to assess to figure out how we're going to account for the lease under ASPE. So let's talk about that. So under ASPE, if one or more of the following criteria is met, and there's 3 criteria, then we'll know if we have a capital lease. So if one of these criteria is met, we have a capital lease. If not, we have an operating lease. So the first test is the transfer of ownership test. So this provides reasonable assurance the lessee will take ownership at the end of the lease term. So if there's a transfer with no additional payment, if there's a bargain purchase option, or if it says in the question that we assume the bargain purchase option will be exercised. The second test is the economic life test, which is if the lease period is equal to or greater than 75% of the asset's economic life, it is assumed that ownership has passed, and the term is generally considered fixed and non-cancelable. And bargain purchase options allow the lease term to be extended at an amount much lower than the expected fair rental value. And the third criteria is the recovery of the investment by the lessor. So if the present value of the lease payments is reasonably close to the asset's market price, then we can assume that the lessor has recovered their entire investment and they're earning a return on the asset. So in order to finish off test number 3, we need to know how to calculate the present value of minimum lease payments under ASPE. And there's 3 things that we need to know in order to do that. We need to know how to account for minimum lease payments, executory costs, and what discount rate to use. So minimum lease payments. So from a lessee perspective, your minimum rental payments are the payments that the lessee has to make to the lessor. So the minimum payments that the lessee has to make. Amounts guaranteed, so related to residual value, is the maximum amount that they can be required to pay. So what have they contractually agreed to pay at the end of the period? And if it's not guaranteed, then we would not include it. Executory costs are any recovery included in the rent for things like operating costs or fixing the light bulbs or painting the building or whatever those costs are, those executory costs. Anything included in the rent payments needs to be deducted before we calculate the minimum rent payments. And in most leases, the lessee may pay these directly. So we take it out of the rent payment. So it would say, the lessee has to make rent payments of $10,000 a month plus $1,000 for executory costs or $1,000 for paying for the janitor or whatever. That would be an executory cost. So we would disregard that $1,000 and we would calculate our minimum lease payments based on just the $10,000. Now, what about the discount rate? So there's 2 important concepts around the discount rate. So there's something called the implicit rate, and there's something called the lessee's incremental borrowing rate. So the implicit rate is what makes the present value of the minimum lease payments plus any unguaranteed residual value equal the fair value of the underlying asset. And this is the rate that IFRS requires us to use this as the discount rate. And we'll talk about how to calculate it. And ASPE uses it as one of 2 rates. The other rate that ASPE, and this is only a concept in ASPE, is the lessee's incremental borrowing rate. So this is the interest rate that would apply if the lessee borrowed the equivalent funds for a similar term and with security. So it might say in the market, the lessee could borrow debt at a rate of 10%. And that would be for the same term, that would be their incremental borrowing rate. So what kind of like a market comparison rate. And ASPE says, ASPE requires the lowest of the 2 rates to be used. So if the implicit rate's lower, you'd use that. If the incremental borrowing rate's lower, you would use that. And why does ASPE do that? It's because it wants to make sure the lessee is not using an artificially high incremental borrowing rate. And it wants to make sure that really we're being conservative in our calculation. Now, this is where you're going to get a difference because IFRS also requires us to calculate the present value of the lease payments, but IFRS always uses the implicit rate. ASPE requires us to use the lower of the implicit rate and incremental borrowing rate. So you would have the same present value of lease payments between ASPE and IFRS if the implicit rate is the lowest rate, because you're going to use the same discount rate under both, and the inputs are going to be the same for the calculation of the present value of the lease payments. Doesn't necessarily mean the accounting will be the same from there, depending on what that means for ASPE, but it does mean that we'll at least have that same present value starting point. However, if the incremental borrowing rate is lower than the implicit rate, you'll have 2 different present values of lease payments between IFRS and ASPE because IFRS always requires us to use the implicit rate. So under ASPE, if the present value of minimum payments is less than 90%, then the lease does not have to be capitalized, at least under this step, and the liability is not recognized. So under ASPE, numerical thresholds are a key decision criteria. And we'll talk about how to set up a template for making sure that we've got our ASPE criteria laid out in the tutorial section. Okay, moving on to objective number 5, account for right of use assets by lessees under IFRS 16 and capital leases under ASPE. So now we've talked about theory, we've seen a little bit of accounting, actually not really any accounting, we've talked about some calculations, and now this is where we're going to talk specifically about the accounting. So let's do a quick review. So the classification approach is ASPE, which is where a lessee recognizes an asset where there is a transfer of the risks and benefits of ownership. And when there's an in-substance purchase of the asset, in substance, even though not economically, maybe the contract doesn't say it's a purchase, but in substance, the asset's been purchased. Therefore, we would recognize it. We would recognize the asset. We'd have a capital lease under ASPE. IFRS uses a contract-based approach, and this sees the lessee's asset as the contractual right to use the leased property, not the transfer of the asset itself. So it's saying, listen, it doesn't matter if we've transferred this asset. Obviously, we don't hold the title to it, but we do have the right to use it, and that in itself gives us an asset and a liability. So the IFRS concept is much broader, and it captures most arrangements that could be considered operating leases under ASPE. All right, so the initial measurement of a right to use asset and lease liability. So how do we account for leases under IFRS 16? So under the contract-based approach, assets and liabilities arise and are recognized at the start of the lease contract. The right of use asset is initially measured at cost based on the present value of the lease payments and including the lessee's initial direct costs of dismantling and removing the underlying asset and restoring the site are also capitalized. The liability is measured at the present value of the lease payments, taking into consideration variable payments, the term of the lease, and the discount rate. So remember that IFRS requires us to use the implicit rate, which is sometimes also referred to as it requires us to use the implicit rate. The lease liability is accounted for at amortized cost using the effective interest. So after recognition, so that's what we do on day one. What happens after day one? Now the lease liability is going to be accounted for at amortized cost using the effective interest method. So each payment is allocated between interest and principal, and the discount rate is used to calculate the interest portion. And estimates are used to determine the lease term, and the variable amounts are reassessed. So if it's a complicated lease with variable payments, then we reassess that each period. And I'm not expecting us to see any of those in the tutorial section. I think those are a little bit too complicated. But this is going to require us to set up an effective interest amortization table, which we've seen in accounting for bonds. We're going to apply something similar in accounting for leases, and we'll take a look at that shortly. The right of use asset is treated similar to an intangible asset. So the cost is amortized to expense over the term of the lease or the useful life. And the asset could be revalued in accordance with the revaluation model, and gains or losses are recognized, and it's tested for impairment when necessary. So let's look at an example of accounting for a lease contract under IFRS 16. So assume the lessee enters into a non-cancelable lease agreement with a lessor on September 1st, 2021. The signing and delivery of the lease happened on the same day. Terms and conditions of the lease. So we've got an economic life of the equipment of 7 years. The lease term is September 1st, 2021 to August 31st, 2025. The lease payment per year in advance, so we know we've got an annuity due basis, is $5,000. And the renewal option is 2 additional years at $4,500 per year. We've got an expected value of the asset, but that's not guaranteed. Title to the leased equipment is retained by the lessor, which is normally the case in all leases. The rate implicit in the lease is 9%. The lessee's incremental borrowing rate is 9%. So it's convenient that those are both the same. The fair value of the leased asset is $24,000, and the lessee expects to take the renewal option, and the lessor expects the lessee to take the renewal option. Okay, so the very first thing we're going to do is we're going to calculate the present value of the lease on the inception date. So the actual term of the lease is, of the initial lease, is only 4 years without the renewal option. So let's just forget about the renewal option right now. If we go back to here, we've got the lease term is September 2021 to August 31st, 2025. So that's 4 years. So you can see in the calculation here, we've changed our financial calculator to begin mode, which is really important. So we are going to put in N as 4 for the 4 years of the base lease. The interest rate is 9. And of course, under IFRS 16, we're using the implicit rate, which is 9%. And we're going to put in the payment, which is $5,000. And that was given here. Lease payment per year in advance, it says, is $5,000. So that's where we got that input. And we're just going to click compute present value. And we'll get $17,656. So that's perfect for the base lease. Now, this one's a little bit more complicated, and here we need to deal with the renewal option because it says that we're expected to take a 2-year renewal option. And the 2-year renewal option, the lease payment's going to change. So our base lease payment is $5,000. In this renewal option, our payment is only $4,500. But this creates a problem for us because we can't put this in as in the same way that we put in the base lease, because what we did in the base lease when we calculated the present value is we said we have time 0 and we have time 4 years, and we're going to pay $5,000 each period. And how much is that worth? So we've calculated it as an annuity due. Whereas with the $4,500, it's only going to be for this 1 year, but we can't put in N as 1 because that makes it seem like it's way back here on our timeline. Whereas we're quite far out on our timeline, but it's only a 1 year. This $4,500 is not going to go all the way back. So if we can put in all the same inputs and put compute present value, the present value would be all the way back. So we get a way, way, way too big of a number. All that we want to know is out in year 4 and year 5, how much is this $4,500 payment worth? So we're going to enter this as a lump sum. So we're going to enter it as the future value of this payment is $4,500. So the way that we're putting this in is we're going to say the payment in year 4 for the renewal period, we're going to say N is 4 because, again, it's at the beginning of the period. I is 9, and the future value is negative $4,500 because it's a payment. And when we compute the present value of that, we're going to get $3,188. And a good way of gut checking this is that you know the present value is always going to be less than the face value. So if you're getting a bigger present value, that just doesn't seem right. Just a 1-year payment. And then we're going to do the same thing with N as 5 and still with the future value as the negative $4,500. And that's going to give us $2,925. And when we add together those 3 components, so the present value of the base lease plus the present value of each of the renewal options, we're going to get $23,769 as our total present value of the payments across the lease. And you can see that here as well. So the journal entry to record the contract and the first payment on September 1st, 2021 is debit right of use asset. So we're putting an asset onto our statement of financial position that's called right of use asset for $23,769. So that's the exact present value that we calculated above. And we're going to credit and put on our lease liability of $18,769. Now, why is that different than the $23,769? Well, we know that on day 1, we have to pay our first rent payment. So we know we have a credit to cash of for $5,000. So the lease liability is simply the difference. And I do want to say that in this situation where we had to deal with the future value of those two payments, it's not necessarily as common of an example as you're going to see through the tutorial section, but at the same time, it is a good example to understand. So what's going to happen then at the end of the year? So that entry that we just saw right here, where we put on the right of use asset, we established the lease liability and we recognized our first rent payment, which is simply cash. It doesn't go through the income statement on day one. Then what happens at the end of the year? So at the end of the year, which is only, remember that our lease was established in September. So December is not a full year away. So we're going to need to record depreciation and interest expense at the end of every year. And we really need to watch our dates here. So our depreciation is simply going to be our right of use asset divided by the years of the lease, which in this case are 6 years, because we are assuming that we're going to take that 2-year renewal option. So the lease changes from 4 years to 6 years. And we were specifically told in this question that the lessee would take the renewal option, that both the lessor and the lessee expect them to take the renewal option. That's enough for us to include it. And then we're going to multiply it by 4/12 here, because remember, we only had, it was in September 1st. So that's 4 months. So 4 months from September 1st to December 31st. So that gives us depreciation of $1,320. You can see the journal entry there is debit depreciation expense, credit accumulated depreciation, right of use asset. So it's important to note, of course, the depreciation expense is going through our income statement as an expense. So that's how we're recognizing rent expense in this period. When we actually make a rent payment, it doesn't hit the income statement, but when we recognize depreciation expense, it goes through. And then we're not hitting the right of use asset directly. We're hitting this accumulated depreciation account, similar to how we would for a capital asset. Then for interest on the lease liability, we're going to take the carrying value of the lease liability, and normally we'll set up a lease amortization schedule here, which we'll talk about. So our carrying value right now is $23,769 minus the $5,000, which is the same as our journal entry we had recorded here. I'm going to scroll back one screen again. So we had recorded $18,769. So 18,769 times 9%, which is our implicit rate, times 4/12 is going to give us an interest expense for this first period of $563. And you can see we're going to say debit interest expense, $563, and credit lease liability, $563. So interestingly enough here, of course, interest expense is going through the income statement, but we're actually hitting the lease liability directly. So we don't hit the right of use asset directly. We're using an accumulated depreciation account, but for the lease liability, we do credit it directly. All right, let's do a recap here of the differences between lease accounting under IFRS and ASPE. So the lease liability. So IFRS says the present value of the lease payments include fixed payments, variable payments, amounts expected under residual guarantees, exercise purchase options, and lease termination penalties. So basically, what's the maximum amount we have to pay? What have we agreed to in the contract? And ASPE requires the lower of the future value of the minimum lease payments or the fair value of the leased asset, or fair value of the leased asset at the lease's inception. The leased asset, IFRS records the initial amount of the lease liability plus any lease payments already made, plus initial direct costs, and ASPE is the same as the lease liability, just matches. Okay. So to determine what amount should be depreciated and the length of the useful life of an asset, we need to understand the terms of the lease and what is included in the capitalized value. So if the asset reverts to the lessor at the end of the lease term, if the lessee does not guarantee any residual value, then IFRS would say that minimum rental payments or lease payments under IFRS 16. We would use the full capitalized amount and the lease term. If the residual guarantees a value, then we would use the minimum rental payments plus the residual value guaranteed. This is just terminology. That's why there's brackets everywhere. And the full capitalized amount, the depreciable amount is the full capitalized amount minus any undiscounted guaranteed residual value included as part of the cost calculation in lease term. We'll see what that means as we progress through. If the lessee retains the asset at the end of the lease term, so if the title's transferred and there's no purchase option, then we would use the minimum rental payments, and the depreciable amount would be the full capitalized amount minus any estimated residual value. So we'll look at an example here where we are going to keep the asset at the end of the term, but we think the asset still has an extra 2 years left. Then we would subtract that out from the depreciable amount. And if title is transferred when the purchase option is exercised, then we're going to use the same thing. When we calculate the lease payments, we're going to include the purchase option. And the depreciable amount is going to be the full capitalized amount minus any estimated residual value at the end of the life. So same idea. So lease payments under IFRS 16 are defined to include fixed payments during the lease term, including those made at the start of the lease, so day one, less any lease incentives, plus amounts expected to be payable by the lessee under certain residual value guarantees, and purchase options if the lessee is reasonably certain to exercise the option. And we'll be given that information in the question. So let's look at another example. Hopefully this will make some of those concepts more clear, because I find just talking through the theory is challenging to grasp the concept. So I think we really need to go through examples both here and in the tutorial section. So a contract calls for lessor corporation to lease equipment to lessee corporation beginning January 1st, 2020. We're told the lease term is 5 years. The agreement is non-cancelable, and it requires equal rental payments of $25,981 at the beginning of each year on an annuity due basis, beginning January 1st, 2020. The lease contains no renewal options, and the equipment reverts to the lessor corporation at the end of the lease. The equipment has a fair value of $100,000 on January 1st, 2020, an estimated economic life of 5 years, and no residual value. Lessor corporation uses straight line depreciation for similar equipment that it owns. Lessee corporation pays all executory costs directly to third parties except for maintenance fees of $2,000 per year, which are included in the annual payments to lessor corporation. Lessee corporation's incremental borrowing rate is 11% per year. Lessor corporation set the annual rental to earn a rate of return on its investment of 10% per year. This fact is known to lessee corporation. So here's what we need to do. We need to determine the classification of the lease under ASPE and IFRS. Then we need to determine the present value of the lease payments, prepare the journal entries, provide the lease amortization schedule, prepare the lessee's journal entries. At the end, we're going to look at the statement of financial position presentation. We're going to prepare the 2021 journal entry. We're going to discuss the subsequent journal entries that lessee will need to record. And we're going to indicate the impact if instead of the equipment reverting to lessor corporation, the lessee purchased the equipment. So let's just get started with our first objective, which is to determine the classification of the lease under ASPE and IFRS. Okay, classification of the lease. So the lease meets the criteria for the classification of a capital lease under ASPE for 2 reasons. 1, lessor corporation uses up all the benefits of the leased asset over the 5-year lease term. Why? The lease term is for 5 years, and we're told that the economic life of the asset is 5 years. So let's take a look back at the question here. The lease term is 5 years. We've got right here, right? The lease term is 5 years. And where does it say? And it says in number 2, The equipment has an estimated economic life of 5 years. So our first criteria under ASPE is whether the lease term is more than 75% of the asset's economic life. In this case, the lease term is 100% of the asset's economic life. So we know we've met criteria 1. And we actually only need to meet 1 criteria in order for it to be a capital lease. So we know that it's already a capital lease. But for the sake of the illustration, let's take a look at number 2, which is what the present value of the lease payments are. And we'll look at that in a minute. I know we're kind of jumping ahead here a little bit, but the present value of the lease payments is $100,000. And this is the same as the asset's fair value. So where does it say the equipment has a fair value? In number 2, it says the equipment has a fair value of $100,000. So if it's greater than 90%, we meet the threshold. And again, it's 100%. So we definitely have met the 2 thresholds here for a capital lease. So we know 100% it's a capital lease. IFRS 16, what's the classification? Well, we know that it's going to need to be set up as a right to use asset because it's not short term. It's a 5-year lease, and we only less than 1 year is a short term, and it's not low value. The lease payments are $25,000. So we know we are already in a right of use asset classification under IFRS. Okay, the second thing we need to do is calculate the minimum lease payments. So how are we going to do that? Well, the present value of the minimum lease payments, and you have to do this calculation under both IFRS and ASPE. And like I said earlier, you could end up with a difference if the incremental rate if the incremental rate is lower than the implicit rate, you will have different present values. But if the implicit rate is the lowest, you'll have the same present value between IFRS and ASPE. So it's the same process, but that one discount rate could end up with a difference. So how do we calculate the present value of the lease payments? Well, first of all, remember that we need to not include executory costs. We had talked about that in one of our previous slides. So anything that's paid for maintenance or what have you as part of the lease payment. So it does say in the question that most executory costs are paid by the lessee direct. So they just pay, the janitor directly rather than it being included in the lease payment. That's fine. We're only worried about what's being included in the lease payment because it will impact our present value. So we're told that there is a $2,000 executory cost included in the lease payments, and we need to take that out. So our lease payments in the question were $25,981.62, and we're going to subtract $2,000 because we don't want that payment to be included in our present value. So now our lease payment per month is $23,981.62, and that's really important. Because if you did this calculation with the $25,981, you would not end up with the right present value. So we really do need to watch for those executory costs. And the good news is they really have to be given very clearly in the question. Now, what interest rate are we going to use for I? So the implicit rate is 10%. And the incremental borrowing rate is 11%. So ASPE says we have to use the lowest of the 2. That means the implicit rate will be 10%. Maybe let's back up for a second. Where did the implicit rate come from? Let's take a look back at the question. Look at number 4. It says the lessee corporation's incremental borrowing rate is 11% per year. So that's obviously the incremental borrowing rate. And then it says lessor corporation sets the annual rental to earn a rate of return on its investment of 10% per year. So when the lessor sets the rental to earn a rate of return of 10% per year, that is the definition of the implicit rate. So it didn't actually use the words implicit rate in that question, but when the lessor, so going back to our previous calculation that we had done to figure out how to earn a specific rate of return for the lessor, that is the implicit rate. So that 10% is our implicit rate. Okay, so if we go back here, so therefore, the implicit rate is going to be 10% under ASPE because it's the lowest of the 2. And IFRS also requires us to always use the implicit rate. Who cares about the incremental borrowing rate? So we're going to use 10%. So therefore, we're going to have the same present value in this question under ASPE and IFRS. So to calculate the present value of the lease payments, we need to make sure we have the begin mode on our financial calculators, really important. And then we're going to put in N5, I10. The payment is going to be the $23,981.62, which is the payment we were given once we've subtracted out the $2,000 executory costs. And we're going to go compute present value. And that present value is going to be $100,000. Okay, let's go back to our, so now we've determined the classification of the lease under both ASPE and IFRS. So ASPE was a capital lease and IFRS, it was a right of use asset. So number 2, determine the present value of the lease payments or the minimum lease payments and the amount to be capitalized under IFRS and ASPE. So in that case, we have the $100,000 that we just calculated. And our third ask is to prepare the related journal entries at the start of the lease under both ASPE and IFRS. So let's take a look at what that looks like. So journal entry at the inception of the lease. So the first thing we're going to do at the inception of the lease is we're going to put the asset and the liability on our statement of financial position. And of course, we're going to have our first lease payment that's due as well, because it's due at the beginning of the period. So you can see there, we've contrasted the journal entries between IFRS and ASPE. Now you can see that all the amounts and the debits and credits are the same. And the cash is the same, but the accounts that we're hitting are the same. So remember, under IFRS, we've got a right of use asset concept, and under ASPE, we're talking capital lease. So it's a different concept. Very similar in the accounting under a capital lease and a right of use lease, but different accounts. So under IFRS, we put the $100,000 on our statement of financial position as a right of use asset. And then we recognize a lease liability, which is the carrying value of the lease liability or the lease payments, what we're required to make. And so we're going to subtract off our first lease payment, and we're going to hit cash for that. So no income statement impact on day one, really important. Even though we're making a lease payment, there's no income statement impact. The fact that that payment is part of our journal entry has already been incorporated into the present value because we know we're using the present value of an annuity due. So it knows the payments are due on the beginning of each period. Now under ASPE, we're putting the same things onto our balance sheet, asset and liability, but they're different accounts. So our asset is called equipment under lease. And the carrying value of the lease of our liability for lease payments is called obligations under lease. And we're also going to recognize, so January 1st, important to remember how we are required to make those $2,000 payments that we had subtracted out. Well, we didn't include that in our present value, but that doesn't mean we don't still have to make them. So every period that we recognize a lease payment, we also need to recognize the payment of that $2,000 that we subtracted from the lease payments to get the present value. So we're going to have debit, maintenance, and repairs expense for $2,000 and credit cash. And that does go through our income statement. Okay, let's go back here. So we did the journal entries at the start of the lease. The next thing we're asked to do is prepare the lease amortization schedule for lease payments. So this is how we're going to calculate the carrying value of the lease liability. Right here, if we look at our journal entry, we can see that under both ASPE and IFRS, our lease liability is the difference between our right of use asset and the payments that we've made. But when we get payments, we need to allocate them between interest and principal. So it's not as easy to just do this on a go-forward basis. So that's why we need to set up this lease amortization schedule. This will help you get the correct answers for questions. So it's really important that you know how to do this. It's very similar to the schedule that we set up for bonds. So it's just a template that you need to memorize. So you can see at the top, it says lessee corporation annuity due basis. It doesn't matter how you set it up, but it's just important for us to keep remembering that this is an annuity due basis. So make sure you have that begin mode on your calculator. So we're going to have the date go through the left-hand column, Then we're going to have the annual lease payment. Just like we had our cash payments on bonds, what are we required to make under the contract? That amount's always going to be the same. Then we're going to have the interest on the carrying value. So this is going to be the implicit rate on the lease, which was the 10%. So we're going to multiply our carrying value times this amount, and it's going to give us our interest cost. So it's important, though, to remember that when we calculate this out, you can see how the dates here are both, you have two dates of 120 because our carrying value, and when we first calculated the lease payment, was 100,000. But it's important to remember this is an annuity due basis. So all of these payments, so that's why we have 120 two times, because this is an annuity due basis. Whereas with a bond, we would have moved on to the next period. So you can see that the interest on the first period is 0. Why is that? Because you could have calculated 100,000 times 10%. The reason for that is because this is an annuity due, so no time has elapsed at the date of the first payment, so no interest has accrued. So it's a nuance that you just need to get used to always putting into your lease amortization schedules, is that on day one, of course, you wouldn't have accrued any interest. And you can see that on day one, the amount, so the second 120 is that 76,018, which is the amount that we had in our journal entry you saw before. So what's happened there is we have a present value of payments of 100,000. We made our first payment on January 1st. As soon as we set up the lease, we cut this check, 23,981, and that gives us a carrying value of 76,018. And then from there, we're just taking that carrying value, so 76,018 times 10% gives us our interest cost. And the reduction of the lease liability is going to be the difference between our annual lease payment and the interest. So obviously the interest doesn't reduce our lease obligation because the interest is going through the income statement as a financing expense. So really all that's reducing our lease liability is the principal. And so that's why 23,000 minus 7,600 gives us that 16,379. That's what we're going to reduce the carrying value of our lease liability by. So 76,000 minus 16,379 gives us that new carrying value of 59,638. Okay, so we'll work through some more of these in the tutorial section, but this is something really important to make sure we know what the carrying value of our lease liability is, and it's also going to give us the right journal entries. Okay, let's go back to the request here. So we've got, okay, so what have we done here? So we've done the classification, we've done the present value of the lease payments. We've prepared the journal entries at the start of the lease. We've done the lease amortization schedule on the annuity due basis, which is always going to be the case, annuity due. And now we're asked to prepare the lessee's journal entries at the end of the year. Okay, so let's go through there. So on the lease amortization schedule, it's just important to recognize that each lease payment consists of a reduction in the principal, a financing cost, and an executory cost. Although we did take that out of the present value. So we just need to remember to always do that $2,000 payment as well. So our December 31st, 2020 journal entries. So we need to accrue the interest on our lease liability, which is straight from our table. So we've got our carrying value of the lease liability. So let's take a look at our table here. So December 31st, which would be, I guess here, would it? Let's see. So the carrying value of the lease liability is 76,018. Yeah. And our our interest expense is going to be here, $7,601 or $2, depending on how you round it. So $7,602. We're going to go interest expense and lease liability. And then Under ASPE, we're going to have obligation. It's the same calculation. It's simply interest expense and obligations under capital lease. So that same interest amortization schedule will work with ASPE and IFRS. You just need to make sure you're using the right interest rates, whatever interest rate's applicable. If the incremental borrowing rate was lower, then we would need to use that rate. The journal entry to record depreciation. Depreciation's a straight line. So we had the right of use asset as 100,000. We're going to divide it over 5 years, which is the term of the lease. That's going to give us 20,000 a year. So we're going to go debit depreciation expense and credit accumulated depreciation right of use asset. And ASPE would say debit depreciation expense, credit accumulated depreciation leased asset. Okay, and the terminology is really important on an exam question between IFRS and ASPE, because that's really what matters, is what account you're hitting. Okay, request number 6 was for us to provide what the statement of financial position or the balance sheet presentation would have been at December 31st, 2020, specifically between current and non-current as well. So the principal portion that's due within 1 year is classified with current liabilities, and the remainder is classified with non-current, which is pretty standard. So far, the current portion of the December 31st total obligation of $76,018 is the principal obligation that will be paid off within the next 12 months. Therefore, the current portion is $16,379 as indicated on the amortization schedule plus accrued interest. So if we take a look here, so we've got under IFRS, our current liability is going to be $23,982, and our non-current is going to be $59,639. So let's take a look at how we got there. The total obligation of 76 is the principal. Okay. Let's see what we've got here. Let's go back here and see what we've got. So I think we're saying that this amount is current $16,379. $16,379, or the lease payment. Actually, this is our lease payment. So $23,982 will be paid off, which is composed of interest and principal. So $23,982 is what's going to be reduced. Let's see. And then the difference is going to go into the non-current liabilities. Let's just see. So right. So 23,982. So we need to look at our carrying value here. So our carrying value is right. So okay. Okay, so we've got, right, so this is our current portion, which is our lease payment in the next year is going to be paid off current. So we know that this is going to be our current portion of our lease liability, and then our non-current is the difference. And it's the same under ASPE. You can see that the accounts are just different. So we've got lease liability and obligations under capital lease. So what's our journal entry at for the lease payment on January 1st, 2021. So this is our second year. So we know what it looks like when we set up the lease on day one, but what happens the next year? The lease is already set up, so we don't need to set it up again. We're already recording the amortization and the interest expense on the components. So what happens on the first day of the month? Well, we know we have to make our lease payment because it's an annuity due basis, i.e. the lease payment's due on the first day of each month. So you can see the first thing we've got at the bottom there is credit cash for $25,982. And that's our total lease payment. Remember, it included our base lease payment plus the executory costs. So now we can group those together if we want, because ultimately we still have to cut our lessor a check for $25,982. And the lease liability is going to decrease by $23,982. and the maintenance and repairs expense is going to be $2,000. So what would happen in our subsequent journal entries? So our entries through to the end of 2024 follow the same pattern. So the executory costs that are assumed by the lessee are recorded in the same way. So we still need to remember to record that $2,000 entry because we're still required to pay it. We just don't include it in calculating the present value of the lease payment. And at the end of the lease, the amount capitalized as the right of use asset is fully depreciated and the lease obligation is fully discharged. So just like with a bond, at the end of the lease, the carrying value of the lease liability and the right of use asset are going to be at zero. If the equipment is not purchased, the lessee returns it to the lessor and removes the related asset and accumulated depreciation from the books. So let's go back to our questions here. Let's check off what we've done. Okay, so we've got the statement of financial position presentation. We've looked at what the journal entry would be on the beginning of 2021. So year 2, January, what does that look like? We just have to make our lease payment. We're asked to discuss the subsequent journal entries that lessee would need to record for the lease. And we talked about that. The end of the lease term, the asset and the liability will be fully depreciated or amortized, and everything will be at zero. We'll return the equipment and we'll clear off our books. Number 9 says, indicate the impact if instead of the equipment reverting to lessor corporation, as we assumed in number 8, at the end of the lease, what if lessee purchased the equipment for $5,000 and expected to use it for another 2 years? So let's take a look at that. Okay, so if instead we purchased the equipment for $5,000 and plan to use it for another 2 years, we would make the following entries. So we already have everything fully depreciated, so we need to clear that out. So we're going to clear out the right of use asset. So we're going to clear out the accumulated depreciation by debiting it. We're going to credit the right of use asset. So the right of use asset is completely off our books. The lease liability is also off our books already because we recognize the interest expense directly. So therefore, no more leased asset and no more right of use asset and no more lease liability on our books. Now what happens? Now we're going to recognize the equipment fresh. So this is putting it on our books in a different way. So rather than hitting right of use asset, now we're going to put debit equipment 105,000, accumulated depreciation 100,000. So we're still going to recognize that we've already recorded 100,000 of accumulated depreciation, and we're going to pay $5,000 cash for the equipment because obviously the lessor wants their $5,000 to transfer the title. So what you can see here is that the net book value of the equipment on our books is $5,000, and we'll amortize the $5,000 over the 2 years and recognize the fact that we're still going to use the equipment. Okay, learning objective number 6. Determine the effect of and account for residual values and purchase options for a lessee's right of use asset or a capital lease. So residual values. So a guaranteed residual value is where a lessor agrees to pay for any loss in value below a stated amount at the end of a lease. If any unguaranteed residual value is not included, then the lessee has no responsibility or obligation for the asset's condition at the end of the lease. Guaranteed residual values are used because it protects the lessor under a loss in estimated value. So they want the equipment to be worth this much at the end. If you guarantee that to them, it definitely takes the weight off their shoulders. It guarantees by the lessee affect the amounts recognized as the leased asset and the lease liability, and it lowers the risk of non-recovery. So again, it's really a benefit for the lessor. It can also be a good deal for the lessee, though, depending on how it works. Actually, a guaranteed residual value is really more for the lessor. I'm thinking of a bargain purchase option. Okay, so how do we account for residual values? So if the residual value is guaranteed by the lessee, there are both economic and accounting consequences. So the accounting difference is that the lease payments that are capitalized as the leased asset are defined to include the guaranteed residual value. So now we're going to pick up that guarantee in our minimum lease payments because now we've contractually agreed to make that payment. Unguaranteed residual values are excluded from our lease payments. If the residual value is not guaranteed, we have no responsibility for it. The unguaranteed residual value, therefore, is of course not included in our present value. So what would the journal entries look like for guaranteed and unguaranteed residuals? So if on January 1st, 2020, the capitalization of the first lease and the lease payment, then we've got if it's guaranteed, we would have $100,000 and our maintenance and repairs expense of $2,000 and our obligation under the lease 76 and our cash of 25,237. So you can see that our lease payment here is higher and our obligation under the lease is higher because we've included that payment into our calculation of the present value. And our depreciation expense is lower because we're subtracting off the residual value because we think at the end of that period it's still going to be worth something, therefore we don't need to depreciate it down to zero. Unguaranteed residual values, we wouldn't include that amount into our capitalized payments, so you can see our equipment under lease is lower. And you can see that our depreciation expense is higher because we're amortizing the entire amount over the 5-year period. And the lease payments, the cash is actually the same in both examples here. So the difference is really around what's been capitalized as the present value of the lease payment or the right of use asset and what would be you can see that the obligation under the lease is different. And the interest expense and depreciation are also different. So the journal entries for guaranteed and unguaranteed. So guaranteed, you can see that we've got different, the second payment is actually exactly the same here. Now assume that the asset was depreciated down to its residual value of $5,000, but the fair value of that the lease's end was only $3,000. Then we're going to have a loss on the lease of $2,000 because we said that it would be worth $3,000, but it would be worth $5,000, which is what everything's going to be worth at the end of the lease, and we're going to need to recognize a loss for the fact that the value is less. Okay, learning objective number 7. Account for operating leases by lessees under ASPE and short-term and leases and low-value leases under IFRS 16, and compare operating and capitalization methods of accounting. So here we're talking about operating leases. Now, ASPE definitely still has this concept of operating leases, and ASPE under IFRS, we only use operating leases if it's either less than a 1-year lease or it's considered an immaterial value. So accounting for bargain purchase options. So this is kind of an aside. First topic, accounting for bargain purchase options. So bargain purchase options are an option that is reasonably certain to be exercised. And it's the amount that the lessor receives at the end of the lease. So basically, like, let's say that you leased a car and you had rental payments every month of $800, and they said, okay, you pay us $800 every month for 4 years, and at the end of the lease, you can buy this car for $100. Who's not going to buy the car for $100? That's obviously a really good deal. So therefore, that would be considered a bargain purchase option, meaning that it's a great deal for the lessee, and you normally it's considered reasonably certain to be exercised, and the question will usually give you that information as well. It'll say it's expected to be exercised. So how do bargain purchase options impact our calculations? Well, if there's a guaranteed residual value, you depreciate the asset over the life of the lease, and the asset reverts to the lessor at the end of the term, of course, with the guaranteed residual. If there's a purchase option expected to be exercised, we're going to depreciate the asset over the economic life of the asset, assuming that the title transfers and the lessee will continue to use it. Okay, a non-capitalization method is appropriated for leases where there's no transfer of ownership or if they're short-term or low value under IFRS. So now we're back onto operating leases. So basically we would recognize something under an operating lease if there's no transfer of ownership under ASPE and there is short-term or low value under IFRS, which we've already talked about. And we won't recognize any asset or liability. The lease payments are simply recognized as rent expense or short-term or low value lease expense and then cash. So the lease rentals are usually recognized on a straight line basis over the term of the lease. So operating leases are honestly quite easy. Unfortunately, they're not used that much. Here's an example. Assume the annual lease payment for an operating or low value lease is $239.82. The payment is made on January 1st of every year. Determine the income statement charge each year and provide the related journal entries. So the journal entry to record the lease payment would be under IFRS, debit, low value lease expense, credit, prepaid rent. And the reason for that is because, actually it should be credit, cash. ASPE, debit, rent expense, credit, cash, and then so the debit should be to prepaid expense and then cash because you're going to recognize it over the year. And then we're going to have prepaid. We're going to reverse the prepaid and recognize the expense at the end of the year. Lease inducements or free rent periods need to be straight lined over the lease. So from an accounting perspective, each period will benefit from the discount. There's no period without rent expense. So as an example, assume that to motivate a lessee to sign a new 2-year lease for a small office space, a lessor agrees to a 2-month free rent period at the end of the lease. How much rent expense should be recognized under ASPE? Well, ASPE, we're going to recognize it this way. So it's 2 years times 12 months, which is 24 months. So the total rent is going to be 24 minus 2, 22 months times 300, which is $6,600. So then if we recognize 66 over 24, it means we're going to only recognize $275 per period. So we're basically just evening out the discount we got in the very beginning to say, how would this impact it if we spread it across the whole period? And under IFRS, how would it be different? Well, this is clearly a low value lease, $300. So we would just recognize it as an operating lease, which is exactly what we're doing under ASPE here as well. So we would have the exact same amount, $275 per month. So basically what I'm saying here is that if we're told that we're being induced to sign a lease and we're going to get free rent for a month, for a year, for 2 years, we need to straight line that free rent over the entire period and recognize it evenly. So it's not like for the first, 2 months or whatever the period is, you're going to have 0 rent expense and then match your rent expense to the payments. What's going to happen is you're going to recognize rent expense in those 2 months when you don't have to remit cash, but you're going to accrue it over the entire term of the lease on a straight line basis to even it out. Okay. So under capital leases, capital versus operating. So a capital lease has higher charges in the earlier years because interest is calculated on a declining liability balance. But the total charge between a capital lease and an operating lease on the income statement is exactly the same. We also recognize an asset and a liability under a capital lease, and this gives us a higher debt to equity ratio, and it reduces our total asset turnover. And our cash flow is the same under both ways because the lease payments to the lessor are the lease payments to the lessor. There's no question about that. Okay, learning objective number 8. Determine the statement of financial position presentation of right of use assets and identify other disclosures required. Given that right of use or capital leases give rise to leased assets and a long-term liability, disclosures are similar to PP&E and intangible assets and financial instruments. IFRS also requires additional disclosures, including the net carrying amount of each class of right of use asset, a separate maturity analysis of lease liabilities, additional qualitative and quantitative information about leasing, depreciation charges, and interest expense. As far as exemptions for IFRS, we have to disclose those. So we need to disclose the expense related to short-term lease exemptions under IFRS, the expense related to low-value lease exemptions, and the amount of commitment for short-term leases, if dissimilar to others. And ASPE requires us to disclose the minimum lease payments for operating leases and the total balance at the balance sheet date and amounts payable for each of the next 5 years. And that concludes part 1 of the Chapter 20 tutorial. I know we covered a ton of ground and we covered some topics a little bit lightly. Now, the tutorial section is going to walk through quite a few questions in detail, so I encourage you to join me there. Thank you.